I have an office probably right around the corner from where Felicia is this morning, and do see clients right there at HAYVN. And we have often thought about how to help small businesses look at their business from a smart budgeting perspective and create financial projections, and the best way to actually teach that. And what I've done is put together a 3-day lunchtime series that is sort of the smallest bite-size pieces of your projections. And the goal is that if you attend today, tomorrow, and Thursday, you will shortly thereafter walk away with some financial projections, a 3-year set of projections that are sort of the cutting edge of what a bank would look at if you're looking for a loan or something like that, or alternatively something that you can manage your business about going forward. Felicia said, just from a logistics perspective, she'll post each of the sessions online the day that I do them. So if you miss one, you can pick it up. And I do have office hours at HAYVN, so we can work one-on-one if you need after the sessions. Okay. Whoops, sorry. So today what we're going to do is walk through, just to sort of socialize everybody who's listening, into the 3 main financial statements that we look at. Walk through the tool that we're going to use, which is, it's called Bottom Line. It's something that was created by some colleagues of mine. It's proprietary to our organization. And then we're going to walk through some homework assignments for each of the nights and a process to get your projections done. But just so that we're all talking the same language, everybody says there are 3 main financial statements that you need to understand your business and manage it better. So I'm going to talk just briefly about what each of the 3 of these are, because then we're going to be diving in and using them in sessions during the week, later in the week. So first of all, starting with your income statement, and I think this is generally a good place to start. This is also called your profit and loss statement, or your P&L. It's one of the easy first look at your business that you can download out of QuickBooks. And it's a nice way to get started in understanding, is your business making money and how is it making money? It does calculate your profitability or lack of profitability over a period of time. So typically you'll see a quarterly income statement. You'll take 4 of them, they'll roll up into your annual income statement. Next to that, your balance sheet is a different tool, and it's basically a statement that lists all of your assets and liabilities for a specific point in time. And that's important to note. So your income statement tracks everything that happened over a course of, call it, a year, whereas your balance sheet will detail your assets, your liabilities, the equity in your business as at one point in time, which is typically the last day of that period that year. Then you look at your cash flow statement, which I think sometimes intimidates people. It did to me when I started learning about it, but for small businesses, this can often be the most important statement to look at. It manages and shows the change in cash over the period that your income statement is making money. So it takes the initial cash balance in your bank account and shows the impact of your business on that cash balance. So some businesses just inherently use a lot of cash, some generate a lot of cash, and understanding that can be really key to measuring and managing your business. So if we take just a slightly more granular look at what we're going to be talking about with regard to your income statement, and I thought it would be helpful just to walk through what this is going to look like. So when we start talking about it relating to your business, some of these terms will be more familiar. So top line, looking at your revenue or income. This is super simple. The income that you make from selling your products, your goods, your services over any period of time that we're looking at. From that, we like to take out what we call a cost of goods sold. And it's exactly the accounting term for what that sounds like, the cost of creating those revenues. Now, for different businesses, this can look at like different things, But the best way to think about it is that any cost that you incurred in creating what you've sold. So this is the very direct cost of producing your products, your goods, your services. And typically, you know, it can be, if I were running a bakery, it would be all of the ingredients that I used, any packaging materials, any direct labor that was associated with creating those baked goods. In a service industry, this would look different. It would be the cost of your labor of delivering the service, but you look at it as direct costs. When you subtract your cost of goods from your revenue, you end up with your gross profit margin. And sometimes you look at this as a dollar figure. Often we like to look at it as a percentage figure, and we can track year over year. But it shows the profitability of those, the products and services that make up your business. From your gross profit, then you take out all of your other expenses. And we call these sort of indirect expenses and overhead. They generally fall into two categories. One would be the expenses associated with selling your revenue, selling, you know, whatever it is that your business sells. So this would include advertising, the salaries of your salespeople, any commissions paid, any shipping charges, and then separately your general and administrative expenses. So as a total category, we call this sort of SG&A. Your general and administrative expenses are your rent, your utilities, any salaries for management, insurance, and other things that you need to be paying to make sure that this business is working. And when I think about that, it's, you know, you want to include anything that you're paying to outside consultants, anything that you're paying to get your taxes done, that would all fall into this category. Once you subtract all of these expenses from your gross profit margin, you end up with your earnings before taxes. Sometimes people call this EBIT, and this is generally looked at as a barometer for how much debt you can raise. If you're needing to take out a loan for your business, bankers will look at this earnings before taxes as a way to size a potential loan. And I think once you take taxes out of that, then you get your net income, which is really the term that people use to describe the overall profitability of their business. So moving on, I think I mentioned earlier, your balance sheet is just a simple listing of your assets, your liabilities, and your equity. And the formula that governs this sheet is your assets should equal your liabilities plus your owner's equity. There are a variety of categories of assets here. I've listed some of them: cash and cash equivalents, accounts receivable, so anybody that owes you money, consider that an asset. Your inventory, sometimes work in progress, you've created something, haven't sold it yet, that's an asset. Your property, plant, and equipment, anything that you own, from machinery that's in your office, readily, you know, all the way to your office itself, if you own that. It can also include intangible assets, things like IP or patents. So now on the other side of the equation, your liabilities, it's anything you owe to other people. It could be accounts payables, it could be notes payable, any time you've taken out a loan, and all of your debt that's outstanding. And then finally on the right, your owner's equity is any equity that's been invested in your business, and added to that what we call retained earnings, or the amount of your net income over time that you've kept in the business. Now, your cash flow statement, I think I mentioned, can be really interesting to look at, and it's important to know under what terms your business uses or generates cash. So from a simple formula perspective, you take your initial cash balance, like what's in the bank at the beginning of your period, and then you add or subtract the impact from the operating activities of your business, which is really just your core business. And the way you get this is you take the income statement from that period and you add or subtract it to your initial cash balance. And if that's all that happens, you're going to end up with your ending cash balance. You may want to subtract or add any cash flows from disposition of assets, or subtract some cash if you've acquired an asset during that time. That would go under investing activities. And then lastly, financing activities, anytime that investments had made into your business or disbursements from your business would be added or subtracted accordingly. So now we're going to switch over, and before I go and switch gears to projecting a spreadsheet up here, I'm going to talk a little bit about Bottom Line, which is this super awesome tool that we use, my team uses probably nearly daily. And the end goal of this is to make financial projections really accessible, no matter what kind of business you have and no matter how big or small. As a general rule, if you see a tab on the bottom that has a blue border, you can make adjustments on those pages. But when we move forward, some of the output sheets that you'll see coming from this, you can't actually make changes on them, and that's how it's supposed to work. And my breakdown of how we were going to accomplish getting projections done in 3 lunchtime sessions, this is how I think it's going to work. I've given you an overview of the type of statements that we're going to be working on, and then breaking it down to actually inputting these for your business is I'm going to introduce you to the tool that has different tabs for different of these topics. But I'm hoping that tonight you can take these tools and take it home and work on your revenue and your cost structure, so that by the time you come back tomorrow, you'll have a good understanding of your different categories of revenue and the costs associated with them. Then we'll work through those tomorrow. Tuesday night, you'll have some homework in terms of working on staffing costs and other overhead like rent. And then we'll come back, and by the end of Wednesday, we'll have completed the entire sheet. So this is, again, my contact information, which you might want to just take a quick screenshot. I think Felicia's going to publish this separately so you can find me easily. And I am going to just switch over my screen to walking through what we call Bottom Line. So you'll see across the bottom, and if you're not super fluent with Excel, don't worry. We're going to make this absolutely as easy as possible by really just working on 1 or 2 of these worksheets every day.
Yeah. So, I don't know if your worksheets are showing. You see your slides still.
Okay, let's give it a second and see. Or do you think it makes sense to stop share and start share?
Yes, stop and start, and then pick another window to share.
Okay, let me do that again. Okay, let me know.
Yep.
Okay, good. So this is Bottom Line, and you'll see across the bottom, there are several different input worksheets, and they're all in blue here. And you can use this tool whether you are starting a business from scratch or whether you have a business that you're trying to manage. And I'm going to start with sources and uses. And I'm first going to make this just a little bigger so it's readable. But let's assume that you're starting a business from scratch. You need to create a budget for how much that's going to cost, and your sources and uses should equal. Now, this spreadsheet highlights in a really helpful way the basic categories of uses of funds when you're starting a business. And the nice part about it is you'll see here next to every amount in the use case, it walks through and automatically calculates the depreciation terms. So you'll see that by the time we get to the end of this, a lot of the hard work in doing these estimates is done for you by the model, which I think is awesome. So under fixed assets, now here is the real estate, land, if you're going to be buying that, buildings, any internal leaseholding and building improvements, something that you may need to invest to get the site up and running, any equipment that you'll need to purchase, furnitures, fixtures, computers, that sort of thing, vehicles, and then other. So we can put in any amounts that you'll need to invest in these basic categories here. Then below that, we look at other operating capital uses in starting a business. This starts from any pre-opening salaries and wages that you'll need to pay people if they come on board pre-opening. Usually you'll need to invest in some amount of inventory, prepaid insurance premiums. These are a bunch of categories that you'll have to think through and budget for. Rent deposits, usually people need to pay some first month or last month for security. Same thing with utilities to get that up and running, supplies, then opening advertising, any license and other startup costs. Generally, you want to look through making an estimate on how much working capital you're going to need until you get to a period of profitability. One way of evaluating that is we can leave that blank, run the model, and see if you're starting your business. If you've got a negative cash position at the beginning, we can back into the amount of working capital needed. Then we take that total and we figure out how we're going to source that. It's generally a combination of owner's equity, outside investors, or some form of a loan. And anything that you type into these will populate the model in terms of, if we create a commercial loan of $50,000, we can create a loan rate and a term, and all of that information in terms of interest calculations and payments will be made throughout the model. And the model has a lot of really helpful tools in terms of making sure that your sources and uses equal. So to the extent that that doesn't happen, it will give you a little warning. What I want people to focus on for today and for tonight is thinking through their revenue opportunities and the cost of those revenue opportunities. So this is really the only page that I'm hoping people can take a look at tonight, so that we come back tomorrow and we can talk about any challenges you had or things like that. Basically, what we want to be able to do is create product lines for what you're selling. And this doesn't have to be a menu like you're going into a restaurant where you need every single thing in here. If it's a food business, I even generally tell people, let's summarize your product lines into things that have similar margins, because it'll be easier than having 100 different product lines where you have to be making assumptions on each of them. So into the B column here, we want to take your different product lines and determine on what basis do we sell them. So if we are a bakery, for instance, and we want to put cupcakes in here, we sell them in a single unit. So here I could even write cupcakes again, and it will populate, down on row 18. Now our sales price per cupcake, we want to say, let's call it $4. And our cost of goods per cupcake, we want to type that in here. I like there to be some analysis to this cost of goods. That's always something that we spend a little bit of time on. For basic food businesses, you could make the assumption that it's a third and type that in here, and then your margin would be $2.68 a cupcake. Then down here, we want to think, and actually I skipped one step here at the very beginning, which is you want to type in your starting year. I'm assuming that we are going to be doing projections that start in 2021 in January. So you'll see here, we'll be making estimates in terms of how many cupcakes do we think we're going to sell in January. There are a lot of ways of figuring out what are reasonable estimates, but I always like to encourage people to start with something that is easily defensible. If we are opening a bakery from scratch, how many customers do you think it's reasonable to get in the door? What are they likely to buy? And let's put forth a set of projections that is inarguable. And then we project that out through the course of the year. In the business that you are in, every business has its unique ups and downs for the course of the year. So we start where we think we're going to be in January, move up and down accordingly throughout the year, and put in what we think will happen. And I like every decision we make in terms of the initial set of projections to be based on it being absolutely inarguable. Like, this absolutely is going to happen. barring something like this pandemic we're in. And we start with that. And then when we layer in all of the different lines that you have for different products, and then in subsequent days, we'll layer in the cost structure, we see if all of those inarguable assumptions land us in a place where this is a profitable business or will be a profitable business in the amount of time that you have that you can invest in it. So hopefully, without a lot of talking, this is the homework page that I'd like to give people, is to think about your product lines, think about what kind of revenue they're making for you and the costs of each of your product lines. And we have also a sales for years 2 and 3 that the model will pretty much calculate it automatically based on the same product lines if we input a growth rate from year 1 to year 2 and year 2 to year 3. So depending on your business, we can talk about what makes sense to put in there. But with that, I am going to stop sharing and go back to talking and see if any questions have come up. I think what we're planning to do is have this model sent out to you this afternoon so you'll have time to look at it. And again, if you're starting your business, I'd love you to look at the sources and uses page as well as the sales year 1. But if you have an existing business, I would say to just look at sales year 1, get your products set up along with your costs, and then we'll go from there. Okay, so any questions? Felicia, do you want to unmute or unmute selectively?
Okay, I see it. You can unmute yourselves because Heights has a question.
Could you talk a bit more about the cost of goods sold for a service firm? And then particularly this, I can't even say it, the distinction between the labor that you put in cost of goods versus say the salary or contractors. And I guess people just say, they just choose where to put that.
Yeah, that's a great question. So when I think of cost of goods, I think of it as the salary costs that you absolutely need to deliver the service. So let's say you run a tutoring company and your job is to match up kids that need tutoring with teachers. So your cost of goods is going to be the cost that you have to pay that teacher to perform that tutoring assignment. The labor costs associated with, maybe marketing or your CEO, that would be an indirect labor cost that would go under selling, general, and admin below the line. Does that make sense? So the cost of the delivery of the service, which in this instance would be the teacher's salary associated with delivering the tutoring, I would put in cost of goods sold.
Okay, so that the salary for that teacher would go in the cost of goods, not under part of general salary.
Yeah. Yeah.
I have a pretty basic follow-up on that. If you are the owner, CEO, whatever, providing those services, it's basically the same answer, is that they are the teacher, correct? Or what's, okay.
Yeah.
Just want to make sure.
But my guess is that as owner, you may want to allocate a certain rate into cost of goods, or it could well be for like a single person business that cost of goods isn't even a necessary construct that you need. It may well be you just skip and you can put that line item under SG&A, or for a lot of solopreneurs, they end up just running it and then taking a distribution out the end, which is another way to look at it.
Sorry, what is SG&A?
Selling, general, and administrative.
Selling, general, and okay.
Yeah. Anything is a good question.
Well, it looks like people probably are ready to dive into the spreadsheet, Christine. They might have more questions tomorrow.
Yeah.
Actually, I'll just ask a question if you don't mind. So I have servers that kind of go across like my product lines, if you will. So that's not a cog, or do I allocate? So what is that? Which category are the servers considered? Server costs.
I think that I would probably keep them under SG&A.
SG&A, okay.
Yeah, because they are across all of your product lines. I mean, if I looked at it a little more granularly, I could think about it and possibly change my mind, but my understanding of your business at a high level would have that under SG&A.
That makes sense. Okay, thanks.
Okay. So I guess we'll wrap this up for today. Does that make sense, Christine?
Yeah.
We'll send out, we have everybody's email from earlier from signing up for this. So we'll send out the spreadsheet and then just come back tomorrow at 12.
Yep.
And tomorrow you don't have to hear me talk. So we'll jump right into Christine presenting and probably more questions and answers at that point.
Yeah. And I hope everybody feels super comfortable just asking whatever questions they have. Like my goal is that if you've signed up for this, by the end of the week, we're going to end up with projections for each of your businesses. And if for whatever reason this isn't a comfortable format, I'm happy to meet one-on-one, or we can follow up by Zoom that way as well.